There's this growing belief that 8% returns are a fantasy, that it's outdated, that it's unrealistic, that nobody actually gets that. And if that's what you believe, I don't blame you. Because we've gotten used to extremes. Either the market is crashing or someone on YouTube is promising you 20%. So 8% feels suspicious. Today, I want to slow this down. I'm going to show you actual examples, broad market data, long-term performance, to show you that 8% isn't a dream number. It's a discipline number. And it's much more achievable than most people think. Let's get right into it. Let's go to Yahoo Finance, a free tool you can use if you have a broker or a site that you use. Go ahead and use that one. We're going to focus on some index. Dave Ramsey talks about saving in 4 different buckets: growth, aggressive growth, growth in income, and international. So let's go look at some funds of different types, index funds, to see what's available. Now, this is just a small example. So let's go ahead and get into the first one. So the first one we're going to do is the Schwab S&P 500 index, just to show you. If we come down here to performance, you can see that this year it's made 1.48% for the calendar year. 5 years, 13%, and come over to the right, and you have a 10-year at 15.53%. That's for 10 years. Now, I know it's been an up market, but you can come down here and look at the total percentage history and see it's had a lot more up than it has down. Even in 2008, with that huge fall of 36%, it still has regained its power and then some, and regained a lot more. So that's just one. Let's look at the large cap now. And let's look at the performance there. All right, so here you can see that this year, this one's gone down 2.91%, but it's still averaged 13.57% for the 5-year. And the 10-year, this is a newer one, so it doesn't have a 10-year on it. But you can see that it's made 15% over the last 5 years. Well, you can see this is the trailing returns. This is the average return. Again, though, it's just showing you that if we come down here to the history, that it's had a lot more up. Even with this big, huge, the 2022 downfall, the following year it came back 42% and then 33%. Again, I know that we've had some great years and people are contemplating that the market's going to go down. Yeah, we're going to have some down years, but over the life of the stock market, it's averaged 11%. So again, getting 8%, it's not hard. Let's do one more. Let's do a mid cap. Go to performance. And this one shows that year-to-date return has made 6%. It's an 8% 5-year return. And if you come over here, you can see that it's had all up years. Now, mid cap, this one shows that it doesn't have huge performance returns. But again, from inception, it's made over 9% on your mid cap. Let's go to small cap. Again, here it's made 8% for the year, 4% for a 5-year return. For the last 10 years, it's done 11%. Again, if we come down here and look at it, even with all the downs, it's still up. So that's out there. You just have to do the research and go. And let's look at an international index and see how the international's done. Let's go down to performance. This has made 8.5% this year. It's made 10% over the last 5 years, and over the last 10 years, it's made 9%. But you can see some of the years it's always been up. Let's come down to the annual total return. It's had up years. It's had down years. But overall, even with this 41% in 2008, it's come back. Look at it. It's had 13 down, 14 down. So that's the thing here is people always are, oh, we've had down years, but it always comes back. Now, some people say, well, you can't say always. Well, in my lifetime, I'm 53 years old. I've been investing for a long time. My money has always done better by just investing regularly and letting it sit there. So what does 8% actually mean? 8% is not what you're going to make every year. There's going to be up years and there's going to be down years. When you get retired, people start freaking out about, we got to put more money into saving. Yes, when you start getting up into the 80s, 70s and 80s, And we don't know how long we're going to live. I get that a lot in the comments. I don't know how long I'm going to live. But I'm going to invest as if I'm going to live longer. And yes, we'll have up years and down years. And yes, I will probably have some money in safer accounts the older I get. But right now, in my mid-50s, I'm investing for the future. I've got at least another good 20 to 30 years that I can invest. And no, I'm not going to put it into a savings account that makes 4 or 5%. I'm going to put it in the stock market. Now, the stock market, let's talk about that. You've got the mutual fund, you've got index funds, and you have stocks. A mutual fund is just a whole bunch of stocks that are combined together into one. So it might take 300 or 400 different stocks and make a mutual fund out of it. An index fund is matching the index, like the S&P 500 index. And then a stock is if you buy an individual stock, is if you buy like Apple or Coca-Cola, which are two of my favorite products. But I don't invest in individual stocks. That's putting all your eggs in one basket. I invest in mutual funds. I do follow the Dave Ramsey path, which I do growth, aggressive growth, growth in income, and international. That's how I divide it evenly, 25% in each one of those. I've been following that for many years, decades, and it's done me well. Now, if you want to just get boring and not exotic, just invest in an S&P 500 index. It's averaged like 10 to 11% over the life of the fund. But you can get better than that if you just do a little bit of searching and dig around. So let's talk about the 3 reasons that people think that 8% is not attainable. Number 1, they watch it too closely. You don't need to look every single day. You're going to have up days and you're going to have down days. Just let it sit there and stew like a good soup or a good stew. Just let it sit there and simmer. It's going to simmer for a long time. You don't know how long you're going to live, and that's okay. But let it do its thing. The second reason that people think that 8% is hard is because I notice a lot that when the market starts dropping, first thing people want to do is want to jump ship. That's totally the wrong lesson here. That's the wrong thing to do. What you need to do is when the stock market starts going down is you need to buy more of it if you can, or just keep investing, because the stock market's going to rebound. It always has, and I believe it always will. So put more money into it. And the third reason is people try to time the market. You can't time the market at all. I mean, look what's happened with gold and silver lately. It's gone crazy. Who would have ever thought that gold and silver and precious metals are going to go up at the same time as hitting 50,000 on the Dow? It's nuts. There's a lot of craziness going on right now, and I know that makes a lot of people feel uneasy. But just follow simple strategies of investing every month in the same thing in good investment mutual funds and let it grow. You'll see dips, that's okay. As you get older and you get more into your retirement years and you feel uncomfortable, then maybe pull some of it out and put it in a safer investment. Me right now, I'm going to just keep investing in my strategy for as long as I can. That's what I do. That's what my dad does. So let's just do a quick example. Let's just say you have $500 to save a month. And let's say you're 30 years old. Let's just say you started late and you started investing $500 a month and you're just making an average of 8%. Now remember, I believe you can make 10 to 12%. But let's just say you make 8%. And I know there's haters out there. You're going to leave it in the comment below. You're going to say, oh, 10% is not realistic. No, it's realistic. Dave Ramsey believes it too. But let's say you have $500 a month and you invest for 30 years at 8%. You're going to have $745,000, $745,000 sitting there. And that's just at 8%. Imagine if it was at 10 or 12%. It's crazy. That's the power of compound interest. So what makes 8% realistic? And I know some of you may be asking, why 8%? That's just a number I had with a video, and a lot of people got upset about it. And I just want to clarify that 8% is something you can do. But remember, 8% is not something you're going to get every single year. You've got to remember, you're going to invest in for the long term, the long haul. You're going to let it sit there, and let it simmer, and let it grow. You need to diversify. I like following the 4 buckets that Dave Ramsey has. Make sure you're investing in something with low fees. You can check those out. Another one is make sure you automate your savings. Just have it automatically come out of your paycheck or have it come out of your account the first of every month, just to let it do that so you get used to not spending the money on that. And remember, During downturns, don't pull your money out. Keep investing. If you have more money, invest more on the downturns. It will come back. Now, I do have to say, none of this is guaranteed. I'm not here to tell you that you're going to get 8%, and I'm not guaranteeing that the future is going to be the same as the past. But we learn from the past and hope for the future. And remember, some decades do underperform, but we're in it for the long haul. Well, I hope you found this somewhat informational, and we've kind of put the 8% to bed, knowing that yes, you can make 8%. If you have any comments or questions, please leave it below in the comments. So you can learn all you want about 8% in saving and investing, but there's a lot more to learn. So just go ahead and click right here and I'll teach you some more. Thanks for hanging out. We'll see you in the next video.